don't hate me, don't throw anything yet. But what you guys have with D. Wade and LeBron now, I am in. I'm landed at 7 o'clock. I'll be home for tip-off, so I'm with you. But I want to talk to something probably not as exciting as the Cavs. We're going to talk about technology. And this is something I'm quite proud of. I've been at Blackrock for a little period of time known as Forever, about 18 years with the firm, joined by way of the merger with Merrill Lynch Investment Managers in 2006. And I've had the privilege of being in a number of businesses, from managing bond portfolios, investment management, portfolio management, 10 years in the institutional business. And the last 5 years of my career have been helping build all the technology businesses at Blackrock. And sometimes you do it a little early, but you have to do it early if you have a vision. And the vision that we had as a firm, it comes from the top of the house. So Larry Fink, about 5 years ago, said, I want to bring our institutional capabilities to the retail market, to home offices, to advisors, because the sophistication of what's happening in the space is no different. And then with every good change in market, what happens? We have a regulatory change. I'm guessing no one here has heard of the DOL? Okay, that was a good laugh. Okay, I got one. So we were thinking about this in a lens that was bigger than just the DOL, but we were thinking about it from an industry perspective. How can we bring what Blackrock has done historically to this market segment? And having the privilege to position a lot of those capabilities with some of the largest pension plans in the world, we're able to use that blueprint to then develop a suite of technologies. Where that's leading to us today is the aspirational goal that Larry has also put out, which is in 5 years, a third of the firm's revenues are going to come from technology. Now, that's technology in really a couple of ways. One is licensing to use our technology. We're going to talk about something called Aladdin, which is the cornerstone of Blackrock. It's going to be talking about utilizing investments within that technology. And then it's going to be also to be able to do more business with you by hopefully providing value for you as an advisor within your practice, be it portfolio construction, be it solving a particular client's problem, because our specific view has also been, how can we do this alongside you? How do we have the combination of technology and the advisor to help provide better outcomes for clients? So what I want to talk about is 3 things today. So the first thing I want to give you just a little bit of background on the technology landscape, and obviously some of these things that are affecting you. Hopefully I can share some thoughts on where we're going and observations we've had. The second thing I want to do is, within that landscape and that backdrop, highlight how we're going after this business and some technologies that are available to you or that will be available to you shortly. And then you can't have a technology presentation without showing some technology. I want to show you one of the technologies in particular. You're getting advance notice that this technology, iRetire, I know many of you have been using iRetire. We're going to be bringing out new functionality, actually on Wednesday. We're going to do a soft launch, so you can check it out. I'll bring it all to life. But I want to show iRetire with a particular lens because I very rarely have the opportunity to get in front of a highly sophisticated audience such as yourself, because it's really cool, it's really neat, it's a great user interface, it helps with a conversation with a client. But we built this off of 5 years of research, innovation, because it's essentially LDI, or liability-driven investing for individuals. So there's our 3 parts, but let's jump into it and talk a little bit about what are the factors that are changing the market. And we talked a little bit about the regulatory environment, we talked about the move to advisory, but the most important thing that you're starting to see is the fiduciary standard has gotten much higher. So when we think about our technology offerings, the way we're thinking about it is how can we give to you, an advisor, a technology that's going to help you either more deeply understand your client's unique goal, and you're going to hear in the next presenter, goals-based investing, or is it going to give you an ability to further understand your book of business? Is it going to help you build a better portfolio for a client? Or is it going to help you expand your practice? Because all of those elements are essential for being a fiduciary. Because as a fiduciary, you now need to make the right decision for your client based on their unique needs and apply an investment solution. Many of you are using model portfolios from asset managers like Blackrock or whomever, many of you are building on your own. But this idea was, how do we bring these capabilities to an advisor? Because the early adopters are going to gain the advantage. We're moving from products to portfolios, to truly solutions-based investments. And that's exactly, obviously, the essence of everyone in this room and your involvement in something like the CFA Society. Technology filling the advice gap, but then the most important thing is behavior. We're going to talk about behavior in the Very hard. It's very hard for all of us to change our own behaviors, and then you want to have your clients change their behavior. But most of the time they don't know what they keep talking about. But some of that is a benefit. But a lot of it becomes a curse, because to really build the trust of your client, you need to be able to have them understand what's going on. And if they can relate to it, it's much better. So I hate that from an analogy, so we're going to do it. Your whole life is this phone. Don't even act like it's not. From when you wake up in the morning to 5 minutes before you wake up in the morning to beat your alarm, to checking the news and the email and this and that. Guess what? Do you know how it works? You don't. But you know what it does for you. And that's really the vision of what we're able to accomplish. Because this vision, let's talk about 3 years ago, the advent of the robo-advisor. And guess what? Robo-advisors were going to take away everybody's jobs. I just want to let you know. Remember that was going to happen? It's not going to happen. It's a combination of technology with human interaction. I'll give you two personal stories. One of it is my father passed away last November. He'd been sick for quite some time. We've had advisors. I was an advisor myself at Merrill Lynch for a number of years. The same set of advisors who I was on the team with are still managing the assets, because you know that's how it works. And good legacy, good value add. This is what everyone does every day. Well, when he passed on, I mean, there are very serious questions. And I could do this. But that little thing called emotion comes in, and it becomes very hard. And it's not just my emotion, it's my mother's emotion, it's siblings' emotion. So that's really where the advisory element becomes so valuable in transition. The second part of it was actually a phone call I was on yesterday. Same advisor, my mom's now looking to downsize her home. It's a very emotional decision. But how do we start to think about the use of annuities? Substituting some income. What if we're going to have to manage two places for a certain period of time while there's a renovation? Is this a good investment? Is it not? What about, we're getting to that season, what about tax trading? Should we raise the capital now? Should we wait till after the beginning of the year? So these are things that are so critical that as much as you want to say that individuals are going to be able to do it on their own, they're probably not going to. So this combination of being able to give that service along with your own advice and being able to help them is critical. And that's where you're seeing 55%, this is a Blackrock Global Investor Pulse survey, 55% of advisors said that they would use a robo-advisor in addition to an FA, not just without an FA. We're also seeing that 70% of high net worths under 45 said strong digital offering is critical. So what does that mean? It means that for you, changing behavior, bringing digital into your practice is going to be incredibly important, because those 45-year-olds, those 40-year-olds, and 35-year-olds, they're going to be your incubated client, that they're going to have a certain experience that they're expecting. They're checking their bank with a thumbprint. They can see all their accounts in one place. Having that part of your practice is going to be critical, because that's going to build into how do you relate to those clients. Back to, hey, do you have trust? Are you sitting on the same side of the table? And let's just be very honest. This robo and digital market is in its infancy. $200 billion relative to the $20 trillion wealth management industry just in the U.S. And I have the privilege of dealing with this business on a global basis, and it's very different. We can talk about different geographies as we like. So, advisors plus technology is the powerful conversation. The blue circle is what you do every day. You're helping advise the client, you're helping get them to financial planning, you're trying to get them to a place that you have a better understanding of who they are and what they want. But the technology is what's going to make it a lot easier. So what if you could have your portfolio automatically rebalance? What if you could spend more time with the client on the goals and objectives? I didn't ask my advisor yesterday once, what about the investment strategy, the model portfolio that we're in? I haven't noticed a Blackrock one. There's the only plan. It's the only product. Okay. I didn't ask about that. I asked about how are we going to hit the numbers that we need to close on Friday to come up with an initial budget for renovations. Truly planning. These are planning conversations, and you know why you want to get the plan. You want to get the plan because you're going to get a third more assets on average. The duration of those relationships are going to extend by 5 to 7 years, and you're probably going to get the siblings, by the way, as the sibling of the mother who was on the phone with the advisor. I mean, these things are real. They really, really happen. So this combination of what you're doing best, along with how you can make it more relatable, and that I want to say it out, that stat about the 45-year-olds saying 70% of them want to have some type of digital experience, this is going to become part of the way. It's going to be part of the way that you're able to see and provide service to your client. And it's a benefit to you. So the advisors who brought technology into their practice, and this is now observation, we're going to talk a little bit about Blackrock's business. We've been very, very much in this business for the last 2.5 to 3 years, working with advisors and firms. We've seen 42% increased assets under management because you're able to aggregate assets, you're able to use the technology to help bring in more conversations. Higher earnings, what we're seeing is the combination of technology, including model portfolios, gets you away from the conversation on fees, but it's more of a holistic service because the portfolio is now an outcome. And then higher satisfaction, and the number one piece of feedback on client satisfaction is, my advisor, to the chuckle earlier, I'm gonna say that 3 more times, I actually knew what my advisor was talking about. When you go to the doctor, I could not be a doctor. I can't see blood, it's terrible. My son screams at me, I was like, oh, we're done. But when I go to the doctor, he's talking in all kinds of riddles. But if he just says, listen, I need you to do this and this, have some water and rest, you're gonna be like, okay, I know what the heck you're talking about. He's like, in 3 days you're gonna be fine. Just like you, it's no different what we're doing. We're providing very sophisticated advice to clients. Okay, so that's the landscape. That's what's going on. That's what's a little bit of a benefit for you and what's happening technologically. So what did we do? So this goes back 5 years ago, but here's how we're attacking the problem. We have a full suite of digital wealth capabilities. Now I'm going to showcase one of them. I retire at the top of the page because that's the one that has the institutional background I want to share. I also have a personal affinity to it. I helped invent it. I was on the team that developed it. So we're going to show that and we'll do the tech demo. But this is a full suite of capabilities that we have at the firm, focusing on your needs. So I retire is a technology focused on everyone's number one goal, retirement income. How much income do I want? How can I close the gap if I'm not on track to hit a certain level of income? And how can I then position an investment portfolio to solve the problem? But here's what's incredibly unique about iRetire. It is the first end-to-end framework, meaning it's for accumulation and decumulation. That, my friends, if you write down one thing, tomorrow night, at the end of the week, go to blackrock.com/iRetire. The decumulation functionality is what's going to be live starting on Wednesday, close of business, but you should check it out. Future Advisor. Future Advisor is a robo capability that we purchased in August of 15. This is a true robo advisor. And what we've done over the last 2 years is not only brought it to market, but we evolved it from a direct-to-consumer platform to one that is built for advisors. So how can you bring in a digital element to your business? We were talking about 45-year-olds. How do you start to bring that into your business where you can onboard clients more efficiently? You can have a dashboard to understand, okay, maybe I can handle 200 clients right now, given how much capacity I have. But you know what, if I have a digital part of my business, maybe I can get an additional 50 or 100 clients, incubate them to a certain level, and then at that point in time, again, you bring them in for specific services. Or they may reach out to you because it is a particular time of purchasing a home or some kind of family situation. So Future Advisor has been very exciting, as has been the ability to evolve it to an advisor platform. Aladdin. So Aladdin is how Blackrock was started. It literally is the cornerstone of the firm. So every mutual fund, every iShare, every institutional separate account globally is on BlackRock's Aladdin system. Well, we've taken these capabilities and said, well, how can we help advisors use something like Aladdin Portfolio Builder? Being able to build a portfolio, stress test it with the same technology that we're using to manage assets. What's interesting about BlackRock, as a money manager, we manage $6 trillion on behalf of our clients. Aladdin is also a service that we have some of the largest sovereign wealth funds, pension funds globally, insurance companies, other asset managers, with about $20 trillion in assets on the system. So it's really the technology heartbeat of our firm. And by the way, everything that you're seeing on the screen, with the exception of iCapital, I'm going to spend a minute on iCapital, all of those elements, iRetire is built completely on Aladdin. Future Advisor elements we've brought in to merge it into Aladdin from a calculation perspective and portfolio construction. And then Aladdin with the portfolio builder or the analytics oversight. This is the way that we built these technologies. These are all technologies in the essence of Aladdin that we offered institutionally. So I had large pension plans who used to have their board reporting off Aladdin on a quarterly basis. They hire BlackRock. They can understand exactly what those investments are. Many of you are facing off with boards in your book of business. How can we have a consistent process and how can we bring that same technology? iCapital is an interesting one. So everything here above the line, these are all holistically. So completely developed at BlackRock, acquired, completely developed at BlackRock. iCapital is very unique. I would put this in the case of probably one of the more cutting edge things and something you should walk away with just a little bit of a tinge of insight. All need to reach out to BlackRock to find out more. But what iCapital is doing is quite simple. We have a vested interest in this company. And essentially, they are helping with the distribution and qualification process for alternative investments. So for many of you, you're doing a couple of things. You're trying to bring alternative investments into your practice, but the qualification process completely sucks. It's really, really hard. And then if you do it once, you don't want to do it again. Well, what if you could do it digitally? I've seen some smiles because some of you are doing all. I get it, okay. So if you do it once, what if you can pre-qualify your client, take them through the KYC process, have a profile built into the iCapital system, so if they want to go ahead and get into this private equity deal or the next private equity deal or the hedge fund deal, the profile is set there now within the iCapital environment. The second piece about it is access. So it's hard to get shelf space. It's hard to get deals. If you're Blackstone and you're doing the next private equity deal, you're probably going to JP, you're going to UBS, you're going to Morgan, you're going to whoever, and you're saying, okay, you guys get 200, you get 300, blah, 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 whatever. So for the RAs, for independents, for many of you building your own portfolios, it's hard to even get access to those investments. Well, now iCapital is going to Blackstone, and yes, we have many Blackstone deals on iCapital, we have Blackrock deals on iCapital. And basically, we're saying, okay, you know, iCapital, you're getting $200 million a lot. And what does Blackstone care? Just like they don't care who's selling it through JP, they want to be able to fulfill. So you're able to get access to these alternative investments. So this is a very unique business that we have invested in. It's one that certainly would be of interest. But the box on the bottom is what I'm most proud of. Actually, I'm really proud of retired, but that's a whole different story. We're going to show that in a second. But the box on the bottom is what makes this a business. So we're onboarding, we're helping you understand, God bless, we're helping you understand how these technologies fit into your practice and learn what you're trying to accomplish. We're utilizing the information to help train individuals, to help train the folks at Blackrock who are working with you. But the last part is ongoing tech enhancements. So just like with that bad iPhone analogy, I mean, how many times a day is this thing updating and you get the little one, 20 to 30 circles, all these updates? We're updating all the time. We're probably on version 7,000 of Future Advisor. I can tell you we're on version 200 of iRetire. So as we're making all these improvements, we're doing it for you. So all you have to think about is Blackrock has the technology and that capability that I find valuable. I want to go ahead and utilize it. The second part of it is we built this as a full business. So everything on the left is, on the right is how you interact with Blackrock, the sales in the field, us being able to work with you. But then on the other side of it, digital marketing, how can we help you start to use the digital means to understand your client base? How can you start to know your clients a little further? The technologies we're building, if they're able to get to that in client, are going to allow you to see how many times did my client interact. Let me give you a perfect example. Future Advisor, if you were to build a robo part of your business, we built an advisor dashboard. And the advisor dashboard will have all your digital clients. And also say assets with you, assets aggregated and held away, when was the last contact, when was the last login. I don't know about you, but that's a very easy sort to say, okay, who am I calling today? So this is how we're building out the technology because we want to be that provider for you. Okay, by the way, questions throughout, anything? All right, let's do something a little more interactive and let's go ahead and actually show you, I want to show you the iRetire functionality. So, how much time do I have here? I got like a half hour or so?
Yes.
All right, let me tell you a story. So, has anybody heard of the Corey indices? That's one person back, you're a Blackrock employee. 2, okay, good. You get nothing, although we're going to Sunday bar next year, I think that was in the back table we talked about that. Okay, so the Corey indices. In July of 2013, Blackrock launched a series of indices called Corey. Corey stands for Cost of Retirement Income. And our goal at that time, I was part of the team that developed it, brought it to market. The goal at the time was, how can we bring a series of indices to help advisors, participants, and investors better understand their retirement savings? So, does everyone remember ING, What is Your Number campaign? Right? It's a pretty good campaign. Listen, ING doesn't even exist anymore. You still remember the campaign, right? And that was in 2012. So our vision, we're like, hey, these guys are really onto something behavioral. That number, I need to think about that number thing. Well, our take was, you know what, we want to own, what does that number mean? So, if you remember the ING What is Your Number campaign, people were walking around with numbers. Some guys were walking around with $2 million under his arm. I think someone was clipping a hedge and saying a zillion or something like that. Anyway, so we said, okay, well, if you're 55 years old and you have $1 million, you think you're a millionaire, right? You're a millionaire. You're great. How many times do you guys have to have this conversation with a client? They're like, I'm a millionaire. I'm all set. It's like, no, you're not actually. Let me tell you what you are. So we developed Corey. And what we said with Corey is we said, okay, well, if you're 55 years old and you have $1 million, how much income can you generate? So I'm just going to a public site. This is blackrock.com/Corey. What this number here, 1592, what that represents, by the way, I would never go this technical, but I am going to get ready to geek out now because I know the crowd I'm in front of, so we can talk about the details of this investment framework. What that number right there represents, 1592, that's last night's closing price of the Corey index. And what Corey is tracking is the median price of a single premium immediate annuity. So arbitrarily, if you said you're 55 years old and you have $1 million, you could tell your client, you know what, if you took all of your money, you bought an annuity at age 65, you can get $63,000 plus a COLA, 2.5% COLA for the rest of your life. So that's a very different conversation with your client. That's a very, very different conversation for your client. And for many of you who are using insurance in your practice, let's just be very honest, insurance is sold. Until you can put insurance in context and understand the unique nature that it can provide in portfolio construction to truly pivot into goals-based investing. So we launched this index in July of 13, and we started tinkering. We put this out there. We were talking to large institutions. We were talking to pension plans. We were talking to the Federal Reserve about putting it on statements for income translation for DC participants. This all actually kind of developed out of our defined contribution business. And we continued to tinker around, and we kind of didn't know what we had, to be very honest. We kind of didn't know what we had. And then one day, Chip Castillo, who invented the whole retirement investment framework, said, well, what if we could evolve this, and we could show somebody where their baseline is, and show them, well, what if they wanted $100,000? How could they close that gap? So that's where we evolved to developing something called iRetire. So this is blackrock.com/iRetire. This went live in May of 2015, so over 2.5 years ago. And what we're doing here is we're evolving this conversation and now use a framework, use technology for you to be able to talk to your client about the retirement goal. So as I mentioned before, tomorrow night this is going to evolve, and this landing page is going to look exactly like this. It's great. I get all kinds of privileges. I get to see stuff that doesn't exist. Anyway, so you should check this out. And the reason is, this is what's happening with iRetire. What we've had in market since May of 15 is this: my client is saving for retirement, accumulation. But what we're going to be evolving it to is the second component. My client is spending in retirement, decumulation, which arguably is the most challenging part of your job. Now there's no fresh capital coming in. You have to draw down these assets. You have to hopefully maintain people's goals, aspirations, and careers. But we have a framework, and it's consistent throughout. But let's take you through, let me show you how simple and easy this is, and take you through how we developed it. So for iRetire accumulation, what we're trying to say is, how can you have a retirement conversation in 3 simple questions? What's your age? How much do you have? How much retirement income do you want? So let's continue with our example. A client is 55, they have $1 million, and they said, you know what, I'd like to have $100,000 of retirement income. So what you see at the bar that formed at the top of the page, that first line, 63,000, that's that same 63,000 that we just had on the Corey site. Corey is providing us this income translation every single day. Why is that powerful? Well, first off, you and your client are actually going to sit on the same side of the table, and they're going to know what you're talking about. But secondly, for those of you who do annuities, the most frequent that you get an annuity quote is monthly. We're now pricing this daily and have been doing so for the better part of 3.5, coming on 4 years. So let's go ahead and close the gap. So our client wants $100,000. They're currently on track for $63,000. Well, what can they do? How can you close that gap? There's only a couple of ways you can do it. There's actually 4. The first way is you say, what if we change our investment horizon or defer? In this case, what if we retired later? You have to contribute. So if you're a pension manager, you have to go and say, I need a capital infusion to our underfunded pension, which would be this field here. Or you can take more risk. And here we're utilizing 9 BlackRock all iShares ETF model portfolios but you get a sense of how these pieces start to come together. Now, the only other way that you could do it, the fourth lever, is you say, guess what, you're not gonna have $100,000, we're gonna have to dial back expectations. But I'm guessing that's probably not the conversation that you wanna have with your client. So why I'm saying it this way is, although this user interface is very, very intuitive, this is pension math. We're using Corey as our liability discount factor, and now we're gonna use our additional functions, such as your client's needs, their ability to save, and the investment portfolio to close that gap, just like a pension plan would. So let's go ahead and do it. So what's happening now in this bar? Well, our client is on track for $63,000. They want to retire at age 65. What if they took their $1 million and they invested it into the most conservative, the 10 equity, 90 fixed income portfolio? Well, what we're showing you here is, based on Blackrock capital market assumptions, in 10 years, our million would grow to something like 1.4, 1.5 million, but we're converting it back to income so you can continue to have that relatable conversation with your client. So here's the most significant piece of feedback, and probably one of the more powerful elements. Advisors who've been using this saying, the iRetire is helping me show the opportunity cost of decisions. So such as, what if our client wanted to retire earlier? Or what if they want to retire later? So you can now contextualize, thinking of the behavioral element of our job, the emotional element of the job. Now you can actually contextualize what that change really means. But let's keep it with a simple 10-year example to start. So in addition to our million, let's assume our client can save and invest an additional $10,000 a year every year for the next 10 years into their model portfolio. And let's say they have Social Security. You can put pension, you can put rental income. Let's say they had $15,000 of Social Security that was going to start at the retirement age of 65. So you see that we've improved our client situation. We have a good plan in place. The last part is then the portfolio, and if we go ahead and move 2 notches to a 30-70 portfolio, we've closed our gap. Now, I don't want to steal the thunder of the next presenter who's going to talk about goals-based, but this is absolutely goals-based investment. But if you put that liability matching, the institutional lens on, what you guys know in and out via the CFA curriculum, we're also changing our benchmark here. And what I mean by that is any pension manager worth their salt, they don't care about the performance in aggregate. What they care about is, are we funded? If we're overly funded, my job may be at risk. If I'm underfunded, my job is definitely at risk. But are we funded? Are we on track with a certain level of liabilities we want to pay out? That's the same thing we're doing here. So now you can go back, and what makes this a framework, because the Corey price is pricing every day, you can now utilize this type of approach to go back with your client, to course correct, to journey manage, to help them understand the situations or discover additional assets, etc. What we've done here with iRetire, all these portfolios, I mentioned Aladdin, we load them down to the ticker and the weight level, and then we run them through the Aladdin risk. So you can start to understand, okay, I've just created the understanding of why this portfolio, the 30-70, would work for my client, but I am the fiduciary, I need to make that trade. Let me understand a little bit more around what the portfolio does. We do have a PDF that you can share with your client. So this is developed for you. This iRetire is not developed for the advisor to use directly, but they can use it certainly with you. But this piece you can then share with your client, how you're going to close the gap. You can keep it on file, and of course you show the solution portfolio. But what I want to talk about, going back to the investment framework and a little bit more the institutional theory, is a couple of things. The first off is, let's talk about what journey management means. What it means is, this is going to price every day, which means you can adjust it every day based on market environment or your client situation. So let's just say it's 1 year from now, your client comes back and says, you know what, unfortunately I can't save the full $10,000 this year, what can we do? Well, you can course correct. You could say, well, you can work 1 year longer, or the more likely scenario would be, let's go ahead and take your investment, let's move to the 40-60 model, and then next year, if you're able to get back to the full savings, we can get you back to the 30-70. This is just like any institutional plan. Please.
Is the asset allocation static during the entire course of the age, the goal that you're aiming to reach?
Yeah, and this one, the asset allocation is static. The way that you would adjust it is if you went into the next year and then you changed it, but on a forward-looking projection basis, it is. The second thing that's important here too is what's included in this calculation. We're talking about $100,000 plus a 2.5% COLA. So why is that important? Well, we're talking about sustainable income. So if you think about the way that normally people are thinking about generating income, you'd say the 4% rule. And there's nothing against the 4% rule. It helps, kind of put context around that conversation. But the 4% rule is not about sustainable income. It's about drawing down 4% of your corpus. So if you have $1 million, you could draw down 40,000, 900,000, 36, 1.1, 4.4, or 44,000. The point is, now you can say, okay, what if you wanted $100,000 plus a COLA every year for the rest of your life? Now let's talk about the rest of your life. Because Corey is actually tracking an annuity price, we're using the Society of Actuaries tables. So we're going out to about 88 years of age, unisex, blue collar, white collar. So essentially the 4% rule, you're saying, hey, we can draw down 4% for the rest of, how long are you gonna live? I mean, you're sitting in the front row, you're a risk taker. So, the point is, now you're tracking it based on average life expectancy. And that's an incredibly different, that is an institutional mindset. That is a very, very unique mindset. So let's go ahead and I want to show you one last thing, and then I want to take you into the new stuff, decumulation. So if you like this and you think this is interesting, great. You're going to absolutely love decumulation because there's absolutely nothing like it in the market and something we're really, really proud of. So many of you are doing financial planning. We talked about the benefits of financial planning. Now the downside of planning, we all know that the average financial plan takes a couple hours to run. You have to get a lot of information from the client, and need a couple days getting back and forth to get the information, et cetera, et cetera. And not only always will that work, turn into a commercial result. It could just be a lot of work, right? This is an incredibly powerful way to position financial planning by pre-qualifying. Somebody may say, you know what, this is great, but I have more goals than just retirement income. They're great, wonderful. We should probably go down the path of a financial plan. And you're increasing your odds of turning that into business. Or they may say, I'm really worried about taxes. You'll notice, obviously, we have not included taxes yet. That will be in 2018, in our retirement. Just thinking about how this can be applied in your practice and some of the feedback that we've had. But the other thing is aggregation. So a client may also say to you, and we just went back to our baseline, 55 years old and $1 million. They may say, you know what, I really like these model portfolios. I actually know what the heck we're talking about here. I'm feeling pretty good. But you know what, surprisingly, you don't have all my assets. I have another $200,000 in an old 401k, maybe I can roll it over. What would that do? Well, you can actually instantaneously show the value of the rollover. That if we included it with our 10,000 of savings and our 15,000 of Social Security, we're actually much closer to $110,000 goal. But let's say they had a risk profile being a 30-70 investor, actually they're much closer to $115,000 goal. And that probably took about 12 seconds. So it's just a great way that you can kind of dynamically adjust these variables. So we've gotten ourselves to retirement, but now let's get ourselves through retirement. And that's where the new functionality. This is what's going to be live again tomorrow night. You'll certainly have it by the weekend. Let's go ahead and decumulate. So the first thing you'll notice is our age range is going to go out for individuals 60 to 85. So let's assume our client, they now are 65 years old. Their million has grown to 2 million. And you know what? They're going to start to collect that $15,000 of Social Security. So now what we're going to show you is how we can generate income. So let's take our $2 million, let's go ahead and put it in the 2080 portfolio. And yep, we're on track for our 101. So what's that showing you? This is showing you can now generate $101,000 of retirement income. What you're seeing here, this range represents one standard deviation of returns over the next 1 year. So if markets do well, we could draw down 104,000. If they sell off, we can generate 99. Now, when we're talking about generating income, what are we really saying? When you go to the view as timeline, here's our projections. For our 65th year, our $101,000 is comprised of $15,000 of Social Security, and of the $2 million that we have in that 2080 model portfolio, very conservative model portfolio, we're going to draw down 86,000. So you are going to be going into that principal amount, but you're able to continue to have that relationship investment in the model portfolio. When we talk about the portfolio drawdown, we click to the portfolio tab. Here's our asset drawdown out to age 85. Here's one standard deviation around that asset level. That what we're saying here is if you would follow this practice, we will have generated $100,000 plus a 2.5% COLA for a 20-year period from 65 to 85. Oh, by the way, I've already had the client's relationship for 10 years prior. And we still have $1.2 million remaining in that model. So you still have liquidity, you still have the ability to transition assets, to draw down to be able to make adjustments if needed. But this is an incredibly powerful exchange. Now I want to show you something. Now we're going to go a little more detailed. When you talk about the Corey, there's a series of prices. And what we'll notice here is going up to age 65, the cost of income gets more expensive. So our 55 was $15.92, 65 is $21.13. So let's call that the clearing price of income. Once you get past age 65, the price goes down. And the reason is because of longevity. Right? Every year you live longer, you're 1 year closer to that 88-year age mortality. But what's happening in there, that price decrease, I know it sucks, right? The benefit of living longer is like you're gonna die. What's happening here though is, you can do quick math. So if you wanna get the current yield, it's about what, 450 here, 1 divided by. This price decrease is about 3.8%. So you're getting a mortality credit, mortality return of about 3.8% just by the sheer nature of the price of the annuity. Now what's interesting, why I'm sharing that, I also get to geek out a little bit, it's okay. It's very similar to this decrease in price here. So what are we really doing with this iRetire? We're showing you how much surplus you can actually spend down to that line that if you ever wanted to fully immunize, your client says, I just want to lock in $100,000 a year. You can always buy an annuity. So where does this come back to? Let's go back to the institutional approach. So we talked about July 13, we launched Corey. Well, in February of 12, General Motors, one of my largest clients, they had 2 pension plans. They had a blue-collar plan, they had a white-collar plan. And one day, they picked up the phone, they called Prudential, they bought the world's biggest annuity, and they closed out the blue-collar plan. Now what happened to the blue-collar pensioner? Instead of getting a check with GM in the upper left, now they get a check with, or upper right, now they get a check from Pru. But what happened for GM? Everything. Their ability to raise debt became a lot easier, their balance sheet got much, much healthier. But GM had, up on 59th Street, 5 floors of actuaries in the Treasury Department that could figure that out, okay? That's what they do. That was our philosophy, is how can we bring that same approach? Because now, just like GM, at any point in time, if you really wanted to bring in an annuity, you can do so. So why don't we continue with an example here? So our client, they're 65, they have $2 million currently in this 2080 model portfolio, and they're gonna generate $101,000 of income. That $101,000 is also comprised of $15,000 Social Security. But what if they said to you, you know what, I want to build a $35,000 income floor. Why don't we go buy $20,000 in annuity? Well, we actually can model that in right here in iRetire. And for those out there, we are not using our balance sheet. Blackrock is not becoming an insurance company. This is all about providing better outcomes and solutions for you in advising your clients. So let's go ahead. Let's model it in. We're going to go buy $20,000 in an annuity. It's going to cost us roughly $423,000. And you're going to notice a few things. First off, we're no longer on track for 101, we're on track for 104. And guess what, our range? Our range went from a $5,000 delta to a $4,000 delta. We built an income floor, which is now muting our volatility, but it's also giving us a higher level of income. So inherently, what we could do, we could take our now $1.6 million, because we bought the annuity for $400,000, put it into the 1090 conservative portfolio. We're back to our 101, and our range is now tightened even further. And you think about this framework, the retirement investment framework is what we're calling, there's a white paper on the iRetire site. You're really doing something very powerful here. You're actually providing guaranteed income as an asset class. So instead of selling that annuity, you're now going to talk about the unique benefits that it can play if you're solving this problem as a goals-based investment. But then what we've done is we've taken our technology and our expertise to make it incredibly user-friendly and beneficial for you, more importantly for your clients, so they know what the goals are. So now when we go into our US timeline, you're going to see our build-up method, that our 101 now is comprised of $15,000 Social Security, $20,000 in the annuity. There is that $35,000 income floor we were looking to establish for our client. And of the $1.6 million we have in now the 1090 portfolio, we're going to draw down $66,000. And you still have $1.6 million at this point in time on the books. And then what I think is really cool, this is just a total third section here. If you look at our drawdown now at age 85, you'll notice a few things. One, look how tight our range is because we brought in the annuity. Secondly, we're no longer on track for
1.2 million, we're actually on track for about 900,000. So you bought an annuity for 400,000, but there's actually only a $300,000 delta. That seems like it's guaranteed income is kind of worth it for the additional cost. So, please, I was going to stop anyway. So question, I got a few more minutes.
Two questions. One, is this available, or will it be available in an app form?
Yes.
Okay. And then the second question is, so this is with a single person. What about for
Couples.
couples where you might have staggered retirements, or I mean, how do you account for that?
Yeah, but right now, so first off, we're likely going to be continuing with just the single mortality unisex as far as Corey. We've seen advisors just blend both the asset pools to have it in one capacity. The timing one is something that's different. We're going to build that in where you can say, hey, this person's retiring at 62, this person's retiring in a couple of years. So that functionality is going to come. One thing I can show you, all in our 2018 roadmap, by the way. So great question. One of the things I want to show you was I glossed over. I was just kind of looking at time. The behavioral element here. So one of the things you talked about was timing as far as when someone's going to retire. So with I retire, the accumulation, what we're showing is the opportunity cost of saving. Are you saving enough? Are you saving long enough? And are you taking enough risk with the savings that you have? With the decumulation, we're showing the opportunity cost of spending. Are you spending too much? Can you actually spend a little bit more? And what about guaranteed sources of spending to supplement that income? Well, what if you had a client who said, because this never happens, hey, I need to spend a lot of money for the next couple of years. Figure it out. So what if they said, okay, you want to spend $100,000 a year, but you know what? For the next 2 years, I want to spend $200,000. Where you're going to notice a few things. First off, we take a big hit on our sustainable income over that full 20-year period. So yes, spending a lot for 2 years is great, but it's going to affect you in the daisy chain. And when you look at that daisy chain, you can see that sequence. So you can, I share this with you because you can see we have the ability to show the timing element. So what if you layered in a second period of time where someone's retiring and how that all comes in? We've also connected it here on that portfolio graph because you can see where your heavy spending curtails and it passes through. So those are all things that are going to be developing. There is an app right now in the App Store. It only has accumulation. Blackrock.com/iretire will have the decumulation, and that'll be in the app starting in February. Yeah, I'll come to this side of the room.
Just out of curiosity, one of your early charts said 55% of the people use a robo-advisor, additionally with a financial advisor. What the other 45%?
They said they go for a robo. Yeah.
Hey, Ross, could you repeat the question? Can you?
55% of the questions to respondents said that they would use a robo-advisor with an advisor. The 45% said they would go to a full robo. That was the response. Yes. This one, and then I think there's one over here. Go ahead.
Embedded in this logic is an expected rate of return with expense volatility.
Yep.
Can you liberate this model, platform to, expected rates of return liberated to higher levels of volatility? You're talking about one standard deviation, could you do it with 3 standard deviation?
So 2 things. One, we're still.
Repeat the question.
The question was, what's the implied rate of return and volatilities that are being utilized, and can we go a little bit more certain from the 1 standard deviation to maybe 2 standard deviation? We're keeping with 1 standard deviation for now, and basically we're getting feedback. I think 2 standard deviations is likely going to happen. The initial goal, even starting with Corey, was how can you get an advisor to actually have the conversation with the client? Because they probably aren't having these types of discussions. We want to get the element of bringing in risk and volatility. I think bringing in 2 standard deviations is likely going to happen because I'm hearing it quite a bit. As far as your expected rates of return, what happens in our retire, Blackrock updates our capital market assumptions on a quarterly basis. So we map any portfolio, so we had those 9 portfolios. We map any portfolio to these 5 asset classes with the expected rates of return and volatilities that you see on screen. Then they're all, obviously we look at the correlations of everything. Everything's really tied mostly to the Corey index, obviously, because Corey's how we're doing our translation. But that updates on a quarterly basis. And from a philosophical perspective, Blackrock has 1 set of capital market assumptions. So if you're the largest pension plan in the world, if you're an advisor, if you're going on this yourself, you're going to get the same ones that we're using to manage money. Let me take the one other question here. I think we may be coming up on time. One here, and then done? Okay, yes.
Can you describe how
Can you describe how the co-branding, or is there co-branding? I appreciate Blackrock should take full credit for this, but my client will go, who's Blackrock?
We've not done our job, my God. Does anyone know who Blackrock is not? Right now, what we're doing is, we may suppress the buy Blackrock with iRetire because we want to make iRetire more of a primary brand. At this point in time, we're starting to do a lot more investment. So there's about 90,000 advisors in the US who have access to iRetire right now. We have done a few strategic partnerships where we've co-branded with a certain firm and whatnot. We may remove the buy Blackrock. That's also something that's been coming up, just like we hear about some of the elements I brought up earlier. But right now, it's, hopefully you could say we're the largest money manager in the world, and this is some of the things we're doing with institutions. But we're really trying to invest in building out that brand, and we're also doing it globally. So my mandate is to get this, we're in the UK, we're not Italy, we're looking at Australia and Asia Pac next. Let me get one more, and I want to be conscious of time here.
Downloaded it. Says,
Whoa.
iRetire by Blackrock exclusively for financial advisors, sign in. So how do we get the sign in? Do
Yeah,
we
so
authorize?
what you want to do is go to blackrock.com,
Okay.
iRetire, create a login and a password, and that same email address that you use and password will be how you get into. That's a great, thank you for bringing that up. That wasn't a comment, that was the most valuable statement in the whole room today. I think we have one more question then.
Okay.
Yeah.
Are you gonna talk loud?
David, don't make it hard. I think it's been a good session.
So that younger folks can actually see a more realistic estimation of what private retirement will.
Well, I'll push back on the more realistic, but no. Great question. So 3 things.
Did everybody hear the question?
No.
The question was, are you incorporating a glide path? Are you incorporating a glide path into this functionality over time? We do have glide path as it relates to Future Advisor, the robo capability, so you can actually have a client wind down over time, and that's optimized on a tax efficient basis. With iRetire, we're likely going to be bringing in the glide path element in 2019, probably not next year. What the big enhancements for next year are going to be, I glossed over it because it's the #1 piece of feedback. Hey, I like this. You start iRetire at age 50. I'd like to bring it down to age 40. That's going to happen in January. So there's a long story short of why we couldn't do it before. Basically, those core indices, what we were doing is we were modeling out cash flows going out to basically death. And then we build a boring bond portfolio of treasuries, treasury strips, investment grade credit to literally do LDI to come up with a basket of bonds to come up with the price of the index, just like the 500 stocks in the S&P 500. We figured a way to do it without having to bring in derivatives. I'll leave it at that. So yes, that's going to be coming. Well, listen. Thank you again.
Thank you very much.
Announcements, and I forgot to say this before. When anybody who got late, when you leave, just tell them you were at the CFA Society Cleveland event, and they'll go ahead and mark your ticket so you don't have to pay for the valet. So as you leave, they weren't supposed to charge you when you came in. Let me know if anybody did pay when you came in. And we're going to take a 15-minute break. They charged you? We're going to take a 15-minute break, and then we are going to get started with Mike at about, just a few minutes after 1:15, and we'll get going with Vanguard, okay? Thank you.
What's that? Don't wake me up before